All right, well, let's get going. My name is Jason Clark, and just want to welcome everyone with us today. We're honored that you take the time to join our webinar series. We're shifting gears a little bit today. In the past, we've been doing things around the equity markets and individual stocks. Today, we're excited to have a special guest, Michael Episcope, the co-founder and co-CEO of Origin Investments, to talk a bit with John Buckingham about finding value in private real estate. So John, editor-in-chief of the Prudent Speculator and also a principal and portfolio manager of Kovitz, is going to lead the discussion with Michael. And if you have any questions after we're done with everything, you can always reach out to me directly at jclark@kovitz.com, or you can call me 949-424-1013. Or you can go to the Prudent Speculator website to get more information, and that can be about Kovitz, the Prudent Speculator, or Origin. So with that, John, I'm going to turn it over to you and let you and Michael start your fireside chat.
Thanks, Jason. And again, thank you, Michael, for taking the time to do this today. I'll begin kind of with a big picture, higher level question. You know, everybody listening on the chat has some experience with real estate, even if it's just as a homeowner. But most of the followers of our newsletter are more, focused on the equity markets. Can you talk a little bit about why real estate, beyond owning your own home, should be part of an overall asset allocation mix for an investor?
Yeah, happy to. First of all, Jason and John, thank you for having me on the show today on the webinar, and appreciate everybody tuning in as well. I think when it comes to real estate, I think you have to look at it like any other asset. And why do you want to add any asset to a portfolio? Well, one of two things, and hopefully both, but you either want lower volatility and or increase returns. And most assets, you're going to get one or the other when you start tilting those in a portfolio or adding them. And real estate is a bit of an anomaly where you get both. You actually get lower volatility and you increase the returns. And when you look at the historical returns over real estate, over the last 40 years, it's certainly kept up with the S&P 500. A year ago, I could have told you that it beat the S&P 500, but real estate is in a recession, going through a little bit of a recovery right now, where the S&P has really done very well. But historically, it's kind of kept up, but with far lower volatility. And it's an interesting asset class because when you think about it, it's both a bond and an equity in a single wrapper. You have bond-like returns because you have leases that act like mini bonds. These are contractual payments, provide stable cash flow, and then you have a hard asset that grows over time because those lease payments increase in value as well. So as an asset class, I think it's not a matter of if you go into real estate, but how much you go into real estate and how you go into real estate. Do you go into the public side? Do you go into the private side? Do you go into multifamily? Do you go into office? Do you go into ground up development? There's so many different ways to access real estate. And it is interesting. I'll tell you maybe a quick story. My partner and I, about 10 years ago, we used to get the question all the time from our investors, well, how much money should I put in real estate as my portfolio? And so rather than us answering it anecdotally, we hired two PhDs to do a study for us, and they looked back the last 10, 20, 30, 40 years, and they looked at private and public. And in the private real estate market, there's an index called the Odyssey Core Equity Index. And basically, it's a levered core index, and they looked at that. And what they came up with, which was really interesting, is that the more real estate they added to the portfolio, the better it did. The better it did on an absolute basis, the better it did on a risk-adjusted basis. So the Sharpe ratio went up considerably. And it was sort of like almost irresponsible to say your portfolio should be 95% real estate and 5% the S&P. But that's what the data suggested at that time. Nobody would suggest that. So, they dialed it back and they said, look, depending on your liquidity, your risk tolerance, a lot of different things, whether you're going to public or private, probably somewhere between 5 and 25% is the right amount of real estate that you should have in your portfolio. So I don't, the data supports all this. I don't think it's an if you should put it in, but how much should be there, and then how do you access it as well?
And then a lot of, again, our clients and readers, they may have a rental property on their own, or or a second house, things like that. But talk to us a little bit about the merits of going into private real estate products such as those that Origin offers.
Yeah, when you're thinking about products, you can go into a fund, you can go into deals. There's pros and cons of all things, and I'll just tell you, by going with a manager like us, you get diversification instantly through our funds. You have a professional manager with a team who wakes up every day thinking about how to generate returns, and people who've grown up in the business who understand where the pennies, the nickels, the dimes are. And it's also a way to passively invest. And if you're doing things directly and you're buying rental properties and you're buying real estate directly, you have to value your time, and you have to also know how much risk you're taking in that. And when we're buying assets or you're investing with us, these are assets you couldn't buy on your own. And we've generated, really good returns over the years. But I think from a risk standpoint, as an LP, you have limited risk. And we certainly have a lot of investors who used to be active. And I think at one point in their career, their life, they believed that they could generate more than a professional manager like us. And they scratched that itch. Some of them have done well, and it's an and. Some of them haven't done that great, and they realize that this business is more complex than what it seems to be on paper. And these are physical assets, and these are mini business plans. And we've been doing this for 17 years and represent a lot of investors and have close to 10,000 units under management today. So it's passive real estate investing isn't for everybody, but I would say that in the long run, if you're thinking about this as a part of your portfolio, funds are far less risky than going about and doing it yourself.
Sure. Now that certainly makes sense. You've obviously talked a lot about the pros of real estate in general and doing it, via a private fund, but maybe talk a little bit about the cons that are out there. We, as somebody who does a lot of reading, New York Times recently had a story about the office market and what a disaster that's been. Maybe talk a little bit about some of the negatives that are out there these days.
Yeah, John, office is totally different animal. I mean, it's extremely to make money in. It was difficult to make money in office even pre-COVID. We always have, brokers and property managers are the ones who make money in office. And there's a reason for that, is because office, it requires so much in terms of tenant improvements, and it's almost a binomial investment return. If you have a big office building and suddenly you lose one of your largest tenants, you could see your equity wiped out completely in that, because the cost to re-tenant can sometimes be $200, $300, $400 in that space. And when you're talking about spaces that are 100,000 square feet, 200,000 square feet, that adds up to a lot of money. I think when you're talking about apartments, there's a certain amount of turnover that you expect that's already baked into the numbers. You have diversification in that. And self-storage is exactly the opposite too. There's no real CapEx. There's not a lot of turnover. There's not a lot of cost in the turnover. I was with my son, it was last week, and I was moving him into his apartment. We had to stop by his self-storage facility, and I kind of had real estate envy looking at this, because here's a building that has metal walls and it has concrete floors, and you go inside and the storage sheds are metal as well, and they have steel beams, and there's virtually nothing in terms of CapEx or anything like that. In a building like this, where it's totally different in an office building where tenant leaves, it's going to cost you millions of dollars and a lot of downtime. And so every asset class is a little different and nuanced. And certainly papers like the New York Times, they pick up the stories that are going to get them a lot of eyeballs on them. And I would say it's very dangerous for anybody just to look at that, because they're really not in the business of providing researched information. And in our business, it really does. It starts by identifying the right asset class, whether that's multifamily, industrial, self-storage, student housing, something that has good long-term fundamentals behind it that is not disruptible. And then equally as important in that choice is picking the right manager, because even if you get the asset class right, this isn't like passive investing in the S&P where the difference between a top manager and a bad manager is going to be 1 or 2 points per year, maybe 3. The difference in real estate can mean 1,000 basis points. It can mean with one manager, you double your money over 3 or 4 years. And with another manager, maybe you're, just barely making your money back. So there's really, there's decisions that go into this. And I do think, normally I would say it starts with the manager, but the reality is that even a great manager in an asset class like office cannot do as well as a mediocre or a good manager in an asset class that has a ton of wind behind it. And then when you're talking about the pros and cons, you want to do funds or deals, I think funds win for a lot of reasons. And, some of them I mentioned earlier, diversification, things of that nature. But there are some cons to investing in a closed-end fund. And two of the big cons, and I'll talk really, there's a difference between a closed-ended fund and an open-ended fund. In a closed-ended fund, your money gets called all at once, and you don't actually put your money to work right away, and you have this contingent liability hanging out there, and you have to figure out what to do with that money. And a lot of the closed-ended funds, they're also not as tax efficient as the open-ended fund, and they're more focused on IRR and multiple. And I wanted to make this point, and I was looking at this Excel spreadsheet before I came on today and just doing this. And so I think one of the biggest mistakes is that people mistake IRR for annualized return, and they're sort of a cousin of one another. But in the private equity world, IRR is the more commonly used metric. And you can think about it like this. If I give you $100 today, or if you give me as the manager $100 today, and in a month from now, I give you $102, that translates into a 26% internal rate of return, which sounds fantastic. But you haven't really made any real money in that equation. And compounding capital is how you get and stay wealthy in real estate. And good real estate just should not be sold. It should be held for long periods of time. And this is why we really favor the open-ended funds versus the closed-ended funds, because you're getting the advantage in open-ended funds of cash flow and depreciation and your tax efficiency, and you're not interrupting the compounding of the asset as well. So I know that was a lot to your question. I wanted to get to kind of all those things. Sure. We can have a whole hour on open-ended versus closed-ended funds versus deals as well.
Sure. No, that's great info. The other elephant in the room, of course, is interest rates. Interest rates have risen. Of course, here lately they've come back down. I suspect that's created some stress and maybe distress in the real estate market. Talk to me a little bit about how that might have affected your space, which generally speaking is multifamily. Are you seeing opportunities in other areas? Is it a bad thing for what you're doing? Talk a little bit about interest rates.
Well, if we would have had this conversation 6 months ago, I would have it would have been very different. And today we really see the light at the end of the tunnel. But just to put this in perspective, the last 2 years, real estate has been in a recession. We've seen record supply coming to market. We've seen interest rates rise. We've seen cap rates expand. And for those of you, just cap rate is the inverse of multiple on earnings. So 2 years ago, your cap rate was about 3.5, which would equate to about a 30 multiple on earnings. And today, cap rates are 5%. So as cap rates go up, valuations come down. So you had not only valuation and your multiple on earnings come down, but you've also had earnings decrease because you've had expenses go up. You've had NOI, net operating income, come down because rents have come down because of supply issue. In terms of your question, are we seeing distress? The answer is no, not today, especially not in the category of property that we deal with, which tends to be more a Class A type multifamily property. We are seeing stress in the system. And to me, this is why there's opportunity today. But when we think about the fundamentals of real estate, the healing process, it stops when you stop putting shovels in the ground. And real estate and all other asset classes are cyclical, and it's a supply-demand kind of imbalance why you go through these phases, and of course, economic reasons as well. But when you stop adding new supply to the equation, we did that about 1.5 years ago, you really create and you're setting yourself up for a lower supply in the period. And that's what we see. Like right now, we are in the teeth of one of the biggest supply deliveries in the last 50 years. And we were forecasting record demand through our program called Litics. I think we'll get into that later on in the presentation. But the reality was, you kind of hold your breath when you see this massive supply, because it's quantifiable. Demand, on the other hand, is not quantifiable. You don't know until it happens. And what we're seeing, especially in the Sunbelt markets, is record demand for a lot of reasons. And so we believe that in the next kind of 6 months to a year, we are going to see the fundamentals improve substantially. And when it comes to investing in this market, you can't time the market, but but you need to start looking in the future and think about where the market is going to be in 6 months or a year from now. And that's kind of what we're doing as this avalanche supply gets absorbed. And just better fundamentals. We have lower rates coming in. You still have renting is far more affordable than owning. So a lot of good things are setting up today, but no true distress. But I do think it's just a great buying opportunity, because when you look at higher multiples in quality assets and you have NOI, operating income, that's been depressed, but then you have good long-term fundamentals, to me, that is the definition of an opportunity.
Great. So, we focus, of course, on the public markets as equity investors. What we've seen is that private or public real estate investment trusts as an asset class have struggled mightily in the interest rate environment. And so just wondering if you can talk a little bit about how private valuations have held up versus public.
Sure. Something happened to my video here. Let me
We got you back. You're there.
You got me back. This is my okay. I lost my my phone video for some reason. That went off. Okay, you're here. Yeah, so I never say it's an or. Public and private are going to mirror each other over long periods of time. The reason why you want to be in the private markets is for alpha. You can get into deals that you're not going to see in the public markets. You can take more risk in the private markets. You can do different kinds of deals than public REITs are set up for as well. But they are going to somewhat mirror each other. And in fact, what's really interesting, I've been studying this, for years, and the public markets almost always lead the private markets, and they tend to lead them by 6, 12, or 18 months. And you can go back and you can see this back in 2022 when the public REITs, and I'm talking strictly multifamily. I look at these every day, keep an eye on them. And the public markets started to lead the way down. And the private markets were still very robust. There was a lot of capital in those markets. And then ultimately, the private markets caught up to the public markets. Valuation started to come down. Capital started to flee the system. It's categorically the opposite today. Public markets have come off their bottoms. And you're right, John, like they've come down significantly over the last few years. And they sort of bottomed out last November when we saw the 10-year hit around 5%, and they're up anywhere between 20 and 35% in the multifamily space. And yet we haven't really seen the private markets recover yet. And it takes a while before capital starts flowing into that market and we see asset prices getting bid up again. And that's really when the capital markets recover, that's when you're going to see asset prices recover. And a lot of times that takes some time. The private markets or the public markets, they have price discovery each and every day. And there's an opportunity sometimes when you see the public markets that have recovered, but there's still an opportunity in the private markets to invest money. So, and this is one of the things that we look at when I talk about some of the leading indicators of why we're excited about what's on the future. Your public markets are a great leading indicator of what's going to happen on the private.
Gotcha. So obviously we're in an election campaign. There's been a lot of rhetoric, a lot of policies that have been floated out there. I know that a lot of policies never actually make it into law. But any thoughts on what you're hearing from the candidates and how that might impact real estate in general?
Yeah, okay. We're gonna leave politics completely aside. I do not have a dog in this fight. The reality is the fundamentals aren't going to change depending on who gets into the White House. I do think if Trump gets elected, You will see an extension of the 2017 tax cuts, which a lot of those do benefit real estate. You have a 20% deduction on REITs. You have QOZ law as well that will likely get extended. You have some, tax laws that are favorable for corporations. And I think in the short run, that will most likely give real estate a boost or help, give it some tailwind. On the Harris side, I don't see anything so concrete that I can say today it's going to help or hurt. I know she came out with a policy that talked about building 3 million new homes across for sale and rental. And I'll be honest, we have a housing shortage in this country, and we do need that. And I'm always going to default for what's good for this country and what's good for the consumer. And we're long-term investors. And I think if the US consumers win, then we also win.
Good, apolitical answer. Well done.
Thank you.
So let's maybe transition a little bit to more specifics about Origin and your focus and your philosophy and strategies. You've touched on it already. The area that you operate in is, multifamily. I don't want to oversimplify it because I know there's more to it than that, but maybe you can talk a little bit about, when you say multifamily, tell us what that means. Is it 10,000, units in an area? How do you look at that?
Yeah, it's a good question and teed up. And I think one of the things that attracted me to real estate is there is no such thing when you talk about real estate. It's so multifaceted. And when you talk to people in multifamily, and the reason why I think information is shared is there are so many different strategies. You can be in workforce housing, you can focus on tax credits, you can focus in a certain geography, you can be in ground up development, you can be an institutional manager, you can be in Class C workforce housing, and so many different kind of ways that you can go. But you have to make choices as a manager. So for us, we invest in Class A apartment buildings that are typically 200 to 400 units in Sunbelt markets. So we're in places like Charlotte and Nashville and Austin and, kind of all the usual places that you would think of. And the reason why we're there, and yes, we're going through kind of a downturn right now in those markets, but we're long-term investors. We think about where's the market going to be in 5 years or 10 years and 20 years, and we're not short-term traders. And what drives investment performance is population and job growth. And I'm going to bet on a Nashville and an Austin over Chicago over the next, 10, 15 years. Now, Chicago is doing pretty well today, but again, these are long-term bets and you don't get to change your mind. We have 3 strategies. We build, we buy, and we lend. And there's a lot of advantages to having 3 strategies in a single asset class is that we see every deal. Our team wakes up thinking about one asset only. When you're investing on the equity and the debt side, there's just an inherent advantage of really understanding every nuance to the asset class and then being able to solve problems and putting capital out in those different structures. And I would also say that within even our multifamily class, there's 2 areas that we focus on. One is traditional, which is more garden and wrap. Those are construction styles. And so when I say Class A, we're not going after the renter who makes $200,000, $300,000, $400,000, the Class A plus the high rise. We're looking to provide what I will characterize as the most affordable option to a demographic we define as a renter by choice. These are people who make $80,000, $90,000, $100,000, maybe more than that. They could buy, but they choose to rent for the flexibility, or, in these day and ages, you just can't buy a house. And that's kind of the way we look at the market. But the build to rent is an important choice as well, because when we think about the millennials, those who are going to buy, but they can't, or those who still want to rent, but they want the convenience of a single family home, they generally don't want to be in a 3-story walk-up apartment building, carrying their groceries up, their kids, things like that. What a build to rent community is you can think about it as single family homes that are purpose built. So there's a leasing office, there's a gym, there's a dog park, there's a kid park, there's all of these amenities that you would typically have in a traditional vertical apartment building, but in a horizontal development. And you need more acreage for this. You can't do this on 2 or 3 acres. You need 15, 20, 25 acres to be able to put one of these build to rent communities in, but they really cater to that demographic. So we think about that. Who is our end tenant? and what are we building to make sure that we're satisfying the demand and sort of the higher end demographics of the market.
Right. That's a good segue then into the actual markets that you're investing in the Sun Belt. Obviously, you're not the only one who knows population is moving there. Is there an oversaturation? You know, how, I guess the question is, how resilient is the market in those areas, you know, to an economic downturn versus, say, Chicago or other places?
Yeah, and you have to separate almost the economic downturn from the asset class, because even though the economy is doing quite well right now, again, real estate is in a recession, and it's in a recession for two reasons. You have the capital market side, your interest rates are higher today, and then you have the operational side because there's just so much supply out there. So we've seen even in some really robust markets that are doing well. Fundamentally on the job side, the real estate has just, you know, kind of, there's been too much of a delivery. But all real estate is going to be cyclical. And what I'll tell you, you know, looking back, there's only been about 3 or 4 times in history that we've seen rental rates decline. So if you're thinking about investing in real estate, then you have to figure out which asset class. And if I'm looking across industrial or multifamily or retail or self-storage, you know, these other ones, we've made the choice to go into real estate because it has produced some of the highest risk-adjusted returns across the board. It certainly beat retail and office on an absolute basis, and then on industrial, it's kept up with the returns. Industrial has done better on an absolute basis, but risk-adjusted multifamily has done quite better on that. And the reason is it's got built-in diversification, you have consistent cash flow, and you have government subsidized debt in multifamily. So the capital markets are always there when it comes to refinancing of an asset like that. I think the key, though, regardless of these different cities that you're in, the key to long-term viability is being in a city that is going to have growth at its back. And I don't want to pick on any cities, but if you're looking at, you know, a city like building an asset like Evansville, Indiana, for instance, or Cedar Rapids, Iowa, you're just not going to have a lot of population growth there. And once you build an asset, you need to put heads in beds, and you need demand for that. And one of the most important variables in terms of long-term investment success is growth of the underlying rental rates. And if you don't have population growth, if you don't have job growth, you cannot push rental rates. And when we're talking about Nashville and Austin, these cities have really good long-term runways in the Sun Belt markets. And the same thing, and this has been going on for 50 years. This isn't a COVID thing. People have been migrating from the north to the south for a long time, ever since the invention of air conditioning. And I don't think anybody's going to wake up tomorrow and say, hey, I want to live in cities with high crime, who are underfunded, who have, you know, bad balance sheets and high taxes. That's not going to happen. That's our thesis. People might feel differently. You know, I don't think these effects of COVID are going to unwind slowly. They're already slowing down, but they're not going to completely reverse themselves.
Right. I mean, demographics seems to be the driver. And again, I come back to that old location being the, you know, first rule of investing. And I mean, logically, what all that you say, you know, makes perfect sense, that go where the people are heading. You mentioned about, you know, rents, and only 4 times, I guess, in history where you've seen a decline in rents. You know, talk a little bit about, you know, affordability. I mean, if rents are always going up, you know, how do you see that trend playing out? I mean, are wages going to keep up to allow these folks to continue to you know, pay the rent and pay the increased rent over time?
Yeah, that's a good question. You have to look at it. There's really, people have 3 choices when it comes to living. I should say the renter demographic today, and you can either rent, you can buy a home, or you can live at home. And so, like, for a lot of people, and there is a huge component of kids who live at home today with their parents, they're saving up money. And when we look at the market today, and you're talking about affordability, one of the metrics we look at is owner's equivalent rent. And owner's equivalent rent has never seen a bigger distortion than where we are today. Historically, people will pay an extra $200 to maybe $300 per month to own than rent. And this makes sense because there's psychological reasons to own, there's tax advantages, things like that. But today, that's over $1,100. There's a massive difference, and it's not even close. Renting is so much more affordable than owning at this point in time. And I'll just say this, that, I think about these distortions and they don't last forever. So then I think, well, how can this come back into line? And there's three ways. You either have, rents get much more expensive, and that could happen. I talked about some of the fundamentals that are changing and the supply disappearing. B, you have interest rates come down substantially, which is going to benefit multifamily as well on the operational side. Or C, you have housing costs come down substantially as well. I don't see the last happening if they didn't when we had mortgage rates at 7% and we still have a housing shortage in this country. And the first two things benefit multifamily investing substantially. So affordability is, like, on a very top level, it's something to pay attention to as a country. When we are looking, though, at a micro level at our submarkets, we were looking at a deal today, or just yesterday in our credit committee, where the in-place rents of an existing asset, we were looking at this for a 1031 exchange program, the affordability ratio was only 16%. And typically that affordability ratio, anything below 30%, means that you can push rent substantially. So you look at something like this, and it means that rent as a portion of their income is such a fraction as compared to people who are already at 28, 30, 32, maybe even 33%. So it does, on a macro level, you have to look at it, but then you have to dig into the details of the individual project to look for those areas where you do have upside potential.
Terrific. Well, let's transition a little bit here and talk about the origin strategies. And as I like to say, your proverbial secret sauce. We feel we have our way of looking at the stock market. We just don't buy buy every stock that's out there. We see value in certain pockets and lack of value in other pockets. So let's talk a little bit about how you do what you do. We've been extraordinarily impressed with your knowledge level. Your team has been fantastic to work with. The collateral material you all produce is sensational. We're all about educating our readers of our newsletter and our clients about what we do and why we do it. And we feel you guys do a great job at that. So that's why I'm really, excited, obviously, to be talking to you today. But, Jason and I have felt comfortable in putting, our clients, into some of your products. But let's talk a little bit about, what sets Origin apart. In my business, our business, of course, people care about returns. And so, what kind of returns, are you looking at these days, on your multifamily deals?
Yeah, there's a lot in that. And John, first of all, I think the reason why, we get along with both you and Jason so well is because we are value-oriented investors as well. So we don't just run in and say, we love real estate and we're going to build anything and everything out there and stuff. And we've seen that story end up very, very badly. So whether we're building or buying or lending, we're looking at this as a very value-oriented investor. And you asked a few things there. Number one was sort of our secret sauce and what makes us different. I think, first and foremost, we're multifamily only. We have a single strategy or a single asset class. We have three strategies within that. So we build, we buy, and we lend within this vertical. And it's really about being an inch wide and a mile deep and understanding all the nuances about the asset class, but also seeing everything that's available to us in our data set out there. And our team does see everything. And it's interesting because I don't want to, opportunistic investing is very high risk. But I would say our strategy, the way it was designed, is an opportunistic way of looking at the world. Because when you have three strategies, I talked about real estate being cyclical. At any one point in time, you can have strategies that are in or out of favor. And a year ago, I would have told you that ground up development was completely out of favor. Today, it's becoming more in favor because there's things moving in our direction. Lending right now, you're being overcompensated for risk. Today, in fact, we're just marks the very first day in 4 years, over 4 years, that we've bought a deal. There was no reason to buy a deal in the last 3.5, 4 years because they were all trading significantly above replacement costs. Rates were going up. Everything was going on there. and that was bad for real estate. And so we stepped to the side, and there's not too many organizations that can do that. Most organizations, they have a single strategy and they say, hey, no matter where the cycle is, we have to do this. And I can't tell you that like all three of our strategies are great in every cycle, but the way that we invest money, when we communicate to our investors about this, here's where we are seeing the greatest risk adjusted strategies. Here's where we are being overcompensated for risk or undercompensated for risk. And so I think, that by itself, just having that ecosystem and that kind of flywheel of different strategies is really important. The other thing, risk management, it really, it's what we think about every day when we wake up. How do we capitalize and underwrite deals? How do we pay our team? How do we manage the company? What is the fine print in the PPM? There's just so many things that go into this. But as individuals who have a lot of money invested in our funds, and the reason why we started this is that we've seen groups that have taken outsized risk, and a lot of times that risk is hidden. And so we're using low to moderate leverage. We're buying high quality deals. We're underwriting conservatively. And our goal is to make sure that we never lose money on a multifamily asset. And to date, knock on wood, we haven't lost money on any multifamily assets. And, maybe a little bit more into the platform. We have 5 offices. We have boots on the ground. We use machine learning, and we have had a great track record as well. Your question, I think specifically was not about our track record, but what kind of returns are we looking for in real estate today? And I'll take you through. So if we're lending, we have a few different lending, but generally we're going to be looking for a mid-teens return on lending. But the beautiful thing about today is that in lending, your asset values have already declined 5, 10, 15%, maybe even 20% in some cases. And you're only lending up to 70, 75% on new value in these asset classes. So you're already in an asset class that has deteriorated, and you're at a much lower part of the capital structure than you were 2 years ago. So for me, when I think about earning mid-teens returns for our funds, these aren't net to investors, I think that's a great place to play. Ground up development today, very similar returns. It's going to be more tax efficient. We're looking at sort of mid to high teen returns in that. And then anything on the acquisition side, those assets are more core plus value add. Those are going to be in the low kind of 10, 11, 12% returns when you're looking today. And typically I'm quoting IRRs, and those are over a 3 to 5 year time period.
Gotcha. So you talked a little bit about, the access to deals. Origin's a large player. Talk a little bit about maybe, what you're able to do versus what, a smaller player might have access to.
A smaller player, I think when you're saying that, you mean somebody using their own money? Is that what you're referring to?
Well, right, and one of the appeals that we've seen is that you have access to government paper, maybe that others don't, because you've been a buyer of said product over time. I guess that's what I'm more getting at.
Yeah, sure. Look, I'll tell you, every single sector that you're in and where you play is going to be competitive. So we used to be, kind of $30, $40 million, and there was competition there. Today we're more in that 60, 80, even $100 million deals. There's competition there. There's competition at the $150, $200 million level. I would say the least amount of competition is going to be where the institutions don't play, in people's backyards, things like that. And there's always some interesting deals out there, but they're not going to be for the institutions, and it's not scalable, and those are one-off deals. What you're referring to, John, is a very interesting program within our credit fund that is the K-Series program. And K-Series is essentially a Freddie Mac bond. So Freddie Mac is the largest lender to multifamily properties, institutional multifamily properties in the country, bar none. And what Freddie does, once they issue those loans, they wrap them up into a bond, and we buy what's called the equity tranche of that loan. And the equity tranche, the reason why we like that is because A, historically, they've had incredibly low loss rates, less than 0.4% over the history. And B, it's very high barriers to entry. There's only about 15 groups in the entire world who are approved by Freddie, we being one of them, who are part of the rotation, part of we call the direct certificate holders. And it's an example of what we look for. High barriers to entry, an edge to the market, and you're talking great risk return characteristics as well. And we buy a bond like that, we can ostensibly generate kind of your low to mid-teen returns in a very safe structure. So that's a program that we absolutely love on the lending side. And then on the equity side, I would say one of the biggest advantages in deal flow is just having those boots on the ground, having 5 offices in the market, having deal officers who wake up every day knowing their data set, knowing the owners, the brokers, everything about that market. Because there's nothing we don't see. And every now and then I'll get a deal sent directly to me and I'll send it to one of our team. And I don't think in the last 4 years, they haven't sent me a note. Yeah, I saw this deal 4 months ago and we passed for these reasons, or we did that. So part of any investment strategy, whether you're in venture or private equity or real estate, is just seeing your available data set. Because how do you know what a good deal looks like unless you're looking at 100 of them and comparing them to one another? So volume itself is a huge advantage for us.
Great. You had mentioned earlier Litics, which is I guess part of your secret sauce. Maybe give a minute or two on what the Litics is that you all do.
Yeah, sure. You're asking me to condense a 1-hour presentation into a minute or two, but I'll do my best. And Litics, it's really interesting because, the innovation really happens when you scratch your own itch. And what Litics does is it is a forecasting tool. It's a rent forecasting tool. And we used to use third-party forecasters. We would rent them, pay a lot of money, and they were just garbage in the market, absolute garbage. And so we actually hired 2 data scientists from the University of Chicago to build this. We put them together with our real estate team. And I remember years ago, I had a friend of mine who was a computer science major, worked at one of the large hedge funds. And he said, look, there's nothing you can't think of that we can't put into a program and make run. And machine learning and AI and data science, where it's going is just absolutely amazing. So when you put people together who know data science and computer programming and then real estate professionals, and you create a model around this, it really produced something quite amazing. And it's the most accurate predictor of rent growth in the market. And what it's done for us tangibly is it points us to markets where there is still value, and points us away from markets or steers us away from markets where there's no longer value and we need to stay away. And it's 1, 2, 3, 4, 5 year forecasts out there. And you can imagine the further out you go, the less accurate it becomes. And you can't forecast things like COVID, and there's always exogenous effects. But excuse me, when we go to a market like Colorado Springs is a smaller market, kind of a sub-market, drafts off Denver, but you want to be there first. And we were there when ground was $25 per square foot. 3 years later, it was $150. We did the same thing in Jacksonville, the same thing in Tampa. And there's a lot of markets even today where there is value, where Litics is kind of flashing green, that we're excited about. But being a value investor, you have to get there first. You can't get there after it's obvious and be paying $150 per square foot, because in real estate, especially in the investment side, basis matters.
Right. Well, you're speaking our language with value. That's obviously what all of us at Kovitz strive to do, and it's a big world out there, and certainly there are facets that are undervalued, and it seems there are always facets that are going to be undervalued no matter what the rest of the market is doing. So this has been terrific in talking about real estate in general. Obviously, kind of a lot about how Origin does it. One final question on that facet, I guess, is maybe it's a simplistic one, but you've had tremendous success. You mentioned deals never gone bad. What happens if one does go bad? What is it seems like at Origin you guys are involved in, you mentioned the flywheel, if you will. So you're not sort of like stuck in a bad area, or maybe there's even a way to fix a deal, if you will, that has gone bad on one end. Maybe talk a little bit about a plan B if you had something that went south.
Yeah, and I want to be clear there, John. We've never lost money on a multifamily deal. We used to do other asset classes, and we did lose money on an office deal that we purchased pre-COVID and sold post-COVID. So that was we've done very
Believe
well
it
in
or not,
office.
we've had a stock that hasn't worked out as well. So
Yeah, right, exactly. So I think about it like this, and you bring up stocks, and it's very diversification is key. And if you think about the S&P 500 in any one year, and even this year when the stock market is up considerably, there's going to be a lot of companies in your portfolio that have lost money. Real estate is no different. And so it's about the choices you make beforehand. And I think about decisions and outcomes. And our job is to make good decisions. And if you make a series of good decisions all the time, you are going to have more great outcomes than bad outcomes in that situation. And when COVID first hit, I'll give you an example. We went out to our investors in April, and we were talking to the investor relations team. And I said, we need to communicate with investors. And they said, well, what are we going to say? We don't know what's going on. I said, that's exactly what we're going to say. But here's what we said is, look, we don't know where the world is. The global markets just shut down. We made some really good decisions. We're in the right market. We leverage correctly. Our business plans are solid. We have a lot of cash on hand, and we're invested with you, and we're going to do everything we can to get to the other side. And so, it's different like in a publicly traded world where if you make a decision, you can just get out. Real estate, you have to see it through to the other side. And you have to think about being a long-term holder, 3, 4, 5, 10 years. And yes, we just went through a real estate recession, but as a longtime investor, I know that I'm going to go through a lot more in the future. And so setting yourself up for success to go through those recessions, which means the right assets, the right cities, the proper amount of leverage is really important. Plan B, I would say, is plan A in making those decisions and saying, what if things do go wrong? And one of the biggest advantages of being in institutional real estate versus doing it alone or as an individual, we have the advantage of non-recourse debt. And I told you about that office building that went bad on us. Well, this was in a submarket of Chicago. Ultimately, we just handed the keys back. And it hurt portfolio returns, but overall, we did very well in that fund. And that was an outlier. Well, we had outliers on the other side. So you have to make sure that when you're investing in real estate, the only thing you have at risk is the equity that you have in the property, and you're not on the hook for the debt. And I think that's one of the main advantages to investing with a professional manager is not having that unlimited risk. Because I've seen this personally in my life where people go and do it alone, and then they sign recourse on everything, and they don't really understand or realize the extent of the risk. But that, to me, is one of the big advantages. So hopefully I answered your question.
yeah, no, that's great. And